So welcome everybody, good afternoon. My name is Michael Chaliassos. I'm happy to be coordinating this CEPR network on household finance and to be welcoming you to our first in-presence conference in 2 years with 2.5 days of activities. So we start today the beautiful new building of Aalto Business School with not the academic conference per se, but an event we have been organizing for about 5 years, the evening before. And this event is addressed not only to academics, but also to practitioners, to policymakers and to regulators. And the idea is to bring together top researchers, top policymakers, top regulators, top practitioners to debate and discuss issues of current importance. Today, we have a very interesting topic on household finance. Financial market participation has been one of the first topics that has been addressed in the household finance literature since its early beginnings about 25 years ago. And it has become extremely relevant recently. And I was not at all surprised, but actually very happy when Samuli Knupfer, the organizer of the event, proposed this topic for today. So without further ado, I pass it on to Samuli to introduce the topic and the speakers.
All right, very much welcome to everybody to this CEPR event that starts off our 2-day workshop on household finance. I'm Samuli Knupfer, Professor of Ownership and Finance here at Aalto University School of Business. I'm co-organizing this conference and also this event together with CEPR. You may have noticed the investing is nowadays everywhere. A couple of keywords: GameStop, Reddit, Robinhood, SPACs. These keywords are one of the many signs of this unprecedented retail investing boom that we have witnessed in the last 2 years. Other, maybe even better signs include the flow of new investors, rising retail trading volumes, and price distortions seemingly created by retail investors. Couple of facts: in the US alone, tens of millions of people have opened new brokerage accounts in the last 2 years. Some estimate put the fraction of retail trades out of total trading volume at more than 1/5 in recent years. Although we have witnessed the boom, one may wonder whether it's already over. Just 2 days ago, Financial Times reported Schwab and Fidelity are still reporting increases in new retail brokerage accounts, at least in the first quarter of this year. So this panel will discuss this retail investment boom. We have 4 speakers. Terry O'Dean is a finance professor at UC Berkeley. He is a pioneer in the study of retail investors. His work has paved the way for a new literature in finance focusing on retail investors. Thanks to his work, we have become to understand that more attention needs to be paid to retail investors. Moto Yoga is an economics professor at Princeton. He has run several research programs in insurance, asset pricing, and household finance. They've had tremendous impact not only in academia, but also in practice. His recent work on asset pricing makes it possible for us to trace the impact of asset demand on asset prices, which is certainly something that is interesting from the perspective of the retail investment pool. Lauri Roosendahl is the chair of Nordic exchanges at Nasdaq. He has held several leading roles in the finance industry at, for example, the Helsinki Stock Exchange, Deutsche Bank, ABN AMRO, and Carnegie. He has been around for such a long time that he has had the opportunity to observe pretty much all the major developments in the stock markets that we know from recent decades. Leena Mörttinen is the permanent undersecretary for international and financial markets affairs at the finance ministry in Finland. Her career includes many roles at Bank of Finland, ECB, Nordea, and the Confederation of Finnish Industries. She has held and holds numerous positions as a board member. The broader audience knows or has gotten to know her as an active commentator of financial market affairs. So these four speakers will first present, and after that we will have a panel discussion. The panel will be chaired by Timo Korkeamäki, the dean of our business school. We have both an online audience and an on-site audience. You get to ask questions during the panel discussion of this event. If you are online, you can use the chat function on Zoom. If you're on site, the usual traditional way of raising hands after Timo has given you the license to do that will work well. Okay, without further ado, the first speaker is Terry O'Dean.
So can you both hear me and see my slides? Yeah, all right, great. Okay, the retail investing boom. I want to start out by pointing out that, as we all know, people trade stocks and retail investors trade stocks for a lot of reasons, and that has been the case for a long time. When the Taiwanese government introduced a public welfare lottery in January of 2002, trading on the Taiwan Stock Exchange dropped 25%, and that persisted for the next 4 or 5 years. So clearly, or not clearly, but it would appear that some of the Taiwanese investors were using the stock market as a forum or a place where they could gamble. And when they had another place to go, they traded a little bit less on the exchange. How have markets? I don't think human psychology has changes very fast, but the environment in which we find ourselves does change. Let's take a look at trading for US investors. 50 years ago, if you wanted to make a trade, you had to call your broker on the phone at a time when your broker was in his office answering his phone. You paid about $16 to buy 100 shares of a $10 stock. And you got your information from the local newspaper, or if you were lucky enough to live in New York, from the Wall Street Journal, which meant that you got yesterday's news today. How are things different now? Well, now you can just trade on an app. You pick up your phone, you place a trade. If you've done it a couple of times, it'll take you less than 30 seconds. There are no commissions. There are certainly spreads and payment for order flow, but as far as the retail investor is concerned, they're thinking 0 commissions. You don't wait for the Wall Street Journal to publish yesterday's news. You can look up news. You open up the Wall Street Journal online, New York Times online, or very likely you're getting news from social media such as Twitter, or you might be going on a site like Wall Street Bets, where you not only are getting news, or you may not even be getting news, but you're getting opinions from other investors telling you what you are doing. All right. So some years ago, Brad Barber and I published a paper, wrote a paper about limited attention of individual investors and the importance of attention. Our point was that there are thousands of stocks out there for investors to buy, but people have limited attention. You can only think about a few things, at around the same time. If somebody gave you a 500 folders with information about the 500 companies in the S&P 500 and said, go home and read all these and decide which company you like, that would be a daunting task. So what we thought probably most individual investors do is they buy stocks that catch their attention. They don't necessarily buy every stock that catches their attention, but mostly they're taking a passive position. A stock catches their attention, then they say, oh, I like that one. Now, why that matters, well, is that it affects buying behavior, but not so much selling behavior. And that's because most individual investors only own a few stocks. In our data samples, investors owned on average around 4 stocks. So if an investor wanted to sell something, she could easily consider, do I want to sell A, B, C, or D? What this means is that when the attention of a lot of investors gets focused on a particular stock, you see a lot of retail buying, not just trading, but the trades are on the buy side. So when a stock attracts an individual investor's attention, or more, I should say, when it attracts many individual investors' attention, investor trading goes up, but that trading is mostly on the buy side of the market. That drives prices up. Usually, subsequently, when the attention fades, the prices decrease, but not all the way back to where they began. Let's look at an example of investors' attention being directed to a stock. On the 7th of January, 2021, Elon Musk sent out a tweet that said, use Signal. He was referring to an app called Signal. However, many investors thought that he was referring to a company called Signal Advance, SIGL. The Signal Advance market cap had been about $7 million 4 days or 5 days earlier. 4 days after Musk sent out his tweet, the market cap was at $480 million. So, the price shot up dramatically because a bunch of investors bought the stock. And also the next day, the day after the tweet went out, the company, Signal Advance, stated quite clearly that they were not the Signal that Musk had been tweeting about, and that they had no particular new news about their company. And the app Signal sent out a tweet saying, hey, we're the ones he was talking about. So the price did come down. So you see this big spike because of retail buying. It comes down, but when it settles down, and this is often the case, it settles to a higher price than it was to begin with. In this case, about 3 times as high of a price. Why? Well, I don't know for certain, and Moto may talk more about this, but I think part of what goes on is you get a lot of investors, they buy the stock, it drives the price up, and they don't all sell it when the event is over. And many of them may not sell it because investors don't like to sell for a loss. So they bought something, now if they sell it, they're going to be selling at a loss. They say, I think I'll just stick with it. And as we'll see in the next slide, it can be dangerous for institutional investors who think a stock is overpriced to actively short the stock. That, of course, is GameStop. And I won't spend too much time on this. I'm sure everyone or almost everyone in the audience knows the GameStop story. It was trading around $10. People got excited about it and promoted it on Wall Street Bets. The stock price shot up to about $350, came back down, went back up, went down, went up, went down, went up. And 2 days ago, it was at about $120. So it's still 12 times higher than when it started. And one of the things that has made this sort of a drama is it's pitted the retail investors who see themselves as sort of politically motivated or monetarily motivated, getting together on GameStop against institutional investors, hedge funds that are shorting GameStop. So even today, GameStop has a current market cap of about 9 billion, and the short interest is 2 billion, which is a lot of short interest. And part of the point here is that it doesn't, just because some institutional investors can do discounted cash flow analysis and decide that a stock is overpriced, doesn't mean that the price is going to go back to where they think it should be. All right, Robinhood, simple environment, limited information, very easy to trade, and it feels a lot like a game. So one of the things that I tell my students is whenever you buy a stock, an individual stock, or you buy a commodity, or you buy an option, first of all, I recommend that they not do that, but that you should ask yourself, who do you think is on the other side of the trade? And it's probably a professional investor. But with Robinhood, it doesn't feel like I'm trading against a professional investor. It feels like I'm playing a video game. So back in 1999, E-Trade ran a commercial, and it was a deep voice. It said it was 2 a.m. It had to be done quickly, efficiently. You were out to make a killing. So you placed an order for that fast-moving stock you were watching without waking your baby or your broker, thanks to E-Trade. Their point was you can trade online in the middle of the night. Today, I think an ad like that would go something like, it was 2 p.m. You were bored. So you bought a stock, you bought an option, whatever, thanks to Robinhood. You could be sitting, some of you may be trading right now. You could be sitting there in the room with the other participants, look down, do a few trades. It's phenomenally easy, and it's a quick way to temporarily get rid of your boredom. What about Robinhood? So I did a study with some co-authors, and we looked at a couple thousand events where the ownership, the number of Robinhood users that owned a particular company shot up in one day. And here's an example. I'll show you just a couple of examples where this was Hertz. The ownership shot up, the price of Hertz shot up, the price of Hertz went back down, but again, it didn't go back down as far to where it started. And in this case, the Robinhood users mostly hung on. Another case was Kodak, similar pattern. We see this pattern many times where the number of users who own Kodak shot up in a very short time. The price shot up, the price gravitated back down, but not all the way back down. And some users sold, but a lot of them stayed in the stock. When we look at 1,000 events, let's see, actually this is slightly more than 1,000 events, but there are 1,000 events where the number of Robinhood users doubled. And after that doubling, the price dropped on average about 10%. And there were 160 events we looked at where the number of Robinhood users went up 6 times and then dropped back down about 15 or 16%. So this is a very typical pattern when a bunch of retail investors converge on a particular stock and drive the price up. Now, I'm sure many of you are familiar with payment for order flow, although Robinhood, E-Trade, Ameritrade, Schwab, none of these companies now are charging explicit commissions. They all get payment for order flow. And Robinhood actually depends on payment for order flow as its main source of revenue. Now, I took a look at the Rule 606 disclosure for Robinhood for March of 2020. And as you can see, the payment for order flow for trades in S&P 500 stocks was pretty small. For non-S&P 500 stocks, it was quite a bit larger. And for options, it was 3 times as high as all stocks put together. And I want to mention this because I think often people ignore the effect of options trading in the short run on the prices of individual stocks. And I'm talking about like retail investor options trading. So the cost, the payment for order flow is about 3 times as high per share for options than for equities. So these are roughly, there were probably during this month more shares traded as part of options contracts for Robinhood users than actual equity shares, but not dramatically more. One thing to bear in mind, though, is that for every dollar that a retail investor spends on an at-the-money 1-month call option, an options market maker is going to buy about $10 of that stock to hedge his or her position. So if an options market maker sells a call option to a retail investor, the market maker is in most cases going to buy the underlying stock. If it's an at-the-money call, probably about half. If it for a contract for 100 shares, the options market maker will probably buy around 50 shares to hedge the position. Furthermore, if the stock price goes up, that market maker is going to be buying additional shares as the delta and gamma change for the underlying option. So it's very cheap in terms of the amount of money that a investor has to spend to buy an options contract that is a week or a month out. But it has a lot of short-term effect on stock prices if a bunch of investors do that at the same time. So stocks are tethered in the long run to earnings. What about cryptocurrency? There's really nothing. If you take a look at Bitcoin, there are no fundamentals. There's no discounted cash flow analysis. So the price of Bitcoin is whatever people are willing to pay for it. And generally speaking, investors like to buy things that have been going up because they think that that's an indication that it's going to continue to go up. And obviously, in the short run, that tends to be a self-fulfilling prophecy. Now, I've got one more slide. I wanted to just talk. I've been talking about speculators. And I think that's mostly what we're thinking about when we see this boom of people trading on Robinhood, and E-Trade, when you see people gathering on Wall Street bets to discuss what's the latest hot stock. And the speculation largely, not exclusively, but largely drives individual stocks, especially these really big booms are usually these like big bubbles and busts tend to be small stocks that a lot of retail investors converge on. But there's another retail investing boom. It's a little bit longer term, but it's the savers. US workers now have defined contribution pension plans. New workers almost exclusively, that's what they get. It's rare to get a traditional pension. They get advised to invest their retirement savings in equity index funds, certainly in equities, and often advised to buy equity index funds. And young workers are advised to put almost all of their retirement savings in the stock market. Now, the rationale for this is historical returns. Historically, the market has delivered very good returns. Very little of the rationale focuses on the historical price to earnings ratios. So that means that we've got a history of returns, but that history of returns may be from a different environment. Now, as long as money keeps flowing into the markets, the prices are going to go up irrespective of earnings. But one thing I know that worries me is that we might be sort of without analysis, just telling people, put your money in the market, put your money in the market, with no discussion of, is there ever a price at which the market is no longer a good buy? And we may have a problem when, say, the baby boomers and the next generation start pulling their money out of the market to live on in retirement. All right, thank you. I will unshare. Mute myself.
All right, hello everyone. As Samuel said, I'm Timo Korkemäki. I'm the Dean of Aalto University School of Business. I want to welcome you all on my behalf as well. I have the honor of guiding. So our next presenter will be Motohiro Yogo, Professor of Economics in Princeton. So Moto, please.
Can you hear me and see the slides? Okay, great. So yeah, thank you for the invitation to be a speaker at this very topical meeting, and then also for Terry for a wonderful introduction. What I'm going to talk about is very connected with what Terry mentioned, which is when retail investors get very excited about a stock, they start buying the stock price goes up. Institutional investors might be trading against retail investors, or they might be riding the bubble. But if you think about our traditional asset pricing theories, or the way we learned asset pricing in graduate school, these kind of narratives that make imminent sense don't necessarily enter our models, or the way we do empirical research in asset pricing. So that was kind of the motivation for how Ralph and I got started. And we have a published paper, it's called The Demand System Approach to Asset Pricing in the GP in 2019. And the idea is that we want to actually incorporate behavior of trading of both retail and institutional investors into our asset pricing models. Okay, so the way we do this is we start with a portfolio choice of households and institutions. So let's say we start with a traditional portfolio choice model, mean variance, but with an additional twist that, let's say, investors have heterogeneous beliefs. So some investors can be like too excited about GameStop, and others are less excited, and so on. So they disagree on what cash flows or expected returns are. And then let's assume that there's a factor structure in returns. Under those assumptions, we derived a portfolio function. It's a logit function where portfolio demands are logit functional characteristics. And this very flexible functional form, which is micro-founded from mean variance, allows us to match both actual data on institutional and household holdings. Once we have these demand functions, we can actually use the portfolio data to estimate these demand functions using an IV estimator. And then once we have the complete set of demand functions, we call it a demand system, then we can do asset pricing applications. So like what happens if retail investors get too excited about GameStop? How can we estimate liquidity as is in price impact of these demand shocks of both retail and institutional investors? What explains all this excess volatility in markets, right? Which investors are driving excess volatility? Which investors are getting too excited? We have a framework to answer those questions, as well as predictability in returns. So like things like momentum and reversal, like what's driving those patterns. Okay, so before I get into the specifics of how we do this, let me just explain that the reason like this research agenda is promising and in kind of a growing area is there's so much availability of data now. So on the institutional side, we have the 13F filings. These are quarterly US holdings of institutions that are managing over 100 million. These data exist since 1980. A version of this for international stock holdings, where coverage is particularly good for US and UK, but there's coverage of mutual funds in other countries, is sold by Thomson Reuters through their ownership product, and also FactSet has a separate data set that does a similar thing. Thomson Reuters EMAX is institutional holdings of corporate bonds and other types of bonds. And this is based on insurance company regulatory filings called Schedule D, which are available since 91. You can merge this with the Fed's balance sheets, which are available since 2003. So this that data allows you to do like kind of bond demand estimation and answer questions like what happens when the Fed does QE, who accommodates QE, and what are the price effects. Ralph and I have a paper with co-authors doing precisely that, like the QE effects of on bond prices using securities holding statistics for the Euro area, which are available since 2014. And for each of these data sets, we know the total shares outstanding. So if we subtract the total shares, subtract from total shares, the aggregate institutional holdings, you get the kind of the retail ownership. On the terms of household portfolios, there's the Statistics Sweden data, which has household portfolio holdings between 83 and 2007. The Norwegian Securities Depository is another data source, goes through 1996 to current period. And of course, the Barber and Odin data uses on brokerage data for 90 to 91 to 96. So these are all like great data sets to use to understand the household trading behavior and how that affects asset prices. Just to summarize, like what's, for example, in the 13F data, in this table, I subdivide the periods into 5-year periods. And then, so in the early part of the data, 1980 to 1984, there are 544 institutions in the cross-section, which covered 35% of the market aggregate market cap for the US stock market. Now, the coverage has improved over time as more institutions enter the data. So by the end of the sample, in the cross-section, you have over 3,000 institutions covering 68% of the market. So the remainder of the market, 32%, is held by retail investors, as well as smaller institutions that do not manage $100 million. One key fact about this portfolio data is these portfolios look very far from like the typical like diversified portfolio that you might expect from like CAPM type theory, right? So the median number of stocks that institutions hold is about 67. Even in the 90th percentile of the distribution, you only have 454 stocks that are being held relative to, there's like over 3,000 stocks in the universe. Okay, so these portfolios are very concentrated, okay? and the markets are very segmented. That's a key fact. Okay, so based on that data, we can estimate what's called a demand system. So Investor I allocates wealth AI across different securities, and then the sum of the portfolio shares have to add up to 1. Okay, that's the budget constraint. We model the demand for security N as an exponential linear function of log market cap and other characteristics like profitability, investment, book equity, and so on. So in logarithms, the portfolio holdings are linear in characteristics. And then the only other equation we need to do asset pricing is market clearing, that the sum of the portfolio demand across all investors sum to the market cap of security N. Okay, so the demand system asset pricing is nothing more than we have portfolio demand functions for institutional and retail investors plus market clearing. That's it. It's a kind of like a 2-equation model. Now, all the content is, of course, in the portfolio demand functions, right? So what is the elasticity of portfolios with respect to prices or the various characteristics? And that's going to determine asset pricing dynamics. Okay, so we estimate these portfolio demand functions for each 13F institution using the cross-section of the holdings. And then we also estimate it for the household sector, which is a residual of the institutional holdings. We do an IV for log market cap, and then we have various characteristics entering our demand function, including book equity, profitability, investment, dividends, market beta. But you can also imagine like other characteristics entering the demand system. So the model is sufficiently flexible that you can put in your favorite characteristics there. Just to summarize like what we found in the JP paper, one key fact is that demand elasticity is uniformly like low across institutions and also retail investors. Okay, so it's less than 1. That is in comparison to like traditional asset pricing theories, like mean variance CAPM implies elasticities over 5,000, right? So we're talking about like the difference between 5,000 and 1, like it's off by 3 orders of magnitude, kind of like, right? This is like kind of should be big news that elasticities are low. Now, this is not the first, we're not the first paper to document this. This is actually a large sample version or confirmation of the earlier literature that confirmed that elasticities are low based on index addition deletions. So for example, Chang, Hong, and Liskovich have this paper based on Russell 1000, 2000 index addition deletions that also find elasticities that are about 1 or less. Now, compared with institutions, household sector has actually slightly higher demand elasticities, although by absolute standards, they're still quite low. They do tilt towards smaller cap, more profitable and higher dividend paying firms. And then also consistent with exactly what Terry was saying, like if you look at the residual part of their demand, which we call latent demand, so the part that's unrelated to characteristics, that thing is like more noisy in the cross section, meaning that they're trading across assets more actively than our institutions. And this was especially true during the global financial crisis. Okay, so the idea is that households get maybe too worried about certain types of certain stocks, and they're trading across sector stocks very actively. So this is one of the tables in the paper where we decompose the cross-sectional variance of stock returns into what share the variance is explained by institutions versus smaller institutions versus household sector. So what we find is that if you aggregate the price effects of the largest 30 institutions in the data, they explain only 4% of the cross-sectional variance. Okay, so the 30 largest institutions manage about 1/3 of the stock market, but they only explain 4% of the variance. The smaller institutions are similar in size in the aggregate to the largest institutions. So the smaller institutions below the top 30 also manage about 1/3 of the market, but they explain 40% of the variance. And then the remainder is explained by households. They also manage about 1/3 of the market, but they account for the largest amount of variance in the stock market, 47%. Okay, so this is again, like kind of consistent with the narratives that people tell that retail investors are trading more actively across stocks and creating all kinds of noise or variance in returns. Okay, so to conclude, I want to say that this research agenda is only in its infancy. There's a lot to do. Now, based on this early evidence, some of the patterns we find, including low demand elasticities and high volatility caused by households or retail investors, is consistent with the earlier literature on household finance. But I think we can only learn so much from aggregated data. So we only have aggregate data for the household sector, but more granular data from Sweden, Norway, or maybe even US could help us get into the details of exactly like how the household sector works, like what stocks are they trading, how are they causing volatility. So there's a lot to do there. And then taking a step back, a complete asset pricing model requires us to understand like how first households allocate wealth to different institutions, including retirement plans, mutual funds, insurance companies, and so on. And then once you allocate to institutions, how institutions allocate across securities is another important portfolio choice. Okay, so each of these dimensions of portfolio choice ultimately, right, affect asset prices, and that's, I think that's what we need to try to build in the literature going forward. Thank you.
Thank you, Modo. Next, we have a speaker here on in 3D here. So I'll invite Lauri Rosenthal to give his remarks next. Lauri, please.
Thank you, Timo. And now we move to the practitioner part. So good afternoon, everyone, and thanks for the invitation. I'll just start by saying that I have worked now 13 years for Nasdaq running exchanges in the Nordic countries. And before that, I worked for different investment banks for a little bit more than 20 years. So I have 35 years of experience in the markets, and that's what I'm going to start with, and describing you a little bit how the Nordic markets, and in particular the Finnish market, looks like. And I will be running this really quickly, and we can take questions then during the panel. So we all know that the Nordic countries have had great GDP growth over the longer time period, with the exception of maybe of Finland during the last 10 years. But on longer term, really good growth relative to everything else. And we have, especially relative to the sizes of our economies and countries, a lot of global industry leading companies, and many industry disruptors that have been created and developed in this region, in the Nordic countries. And as a result of this, partly, I would argue that when you start looking at our stock markets, they have been the best in the world for quite some time. And this is a 55-year statistics that I stumbled on back in the day, originally created by Credit Suisse. And this is annualized total return, including dividends, corrected for inflation. And it's quite extraordinary, actually, that the markets that Nasdaq happens to run in the Nordic region are Sweden, Finland, Denmark, plus then Iceland and 3 very small Baltic countries. This is pretty good evidence of good economic growth resulting in great returns on an equity market in small countries that are also very, very open for investors all around. And just as a note there, that the foreign ownership in listed companies in Finland, Sweden, Denmark is above 40%. So there's a huge influx of foreign capital in our markets, and have been for many, many years. So great returns, available also for households, if they would be interested. And they are. Then, in terms of listed companies, you've probably seen a lot of statistics of the fact that the number of listed companies in the Western industrial countries is structurally declining. That has been the case in the Nordic markets as well, on a country level, but also on the aggregate, if you look back into the kind of post-internet boom and bust cycle. However, last 10 years in the Nordic countries, as you see here from the aggregate on the bottom row, last 10 years, there has actually been growth, net growth. Lots of companies coming in, lots, of course, also disappearing, but net growth. And that's the only actually exchange group, again, in the Western industrialized countries that can show that there is actually net growth on the stock market in terms of number of listed companies. And as you can see, market capitalization has developed quite favorably, where the bottom was there back in 2008 at 400 billion euro, now at 2,000 billion euro in total. And you see the number of main market listings coming in up in the right-hand corner. But now comes the hidden gem in our markets. And this is really extraordinary, and you can't find this really of this magnitude anywhere in the world. And this is the junior market for small growth companies that we run in these countries. And as you can see, the number of companies has grown from around roughly 100 10 years ago or so, and now at more than 550. And we are actually on a trend where we will have more companies on the junior markets, really small companies, than we will have on our main markets within, I would say, 2 years, depending on a little bit the listing momentum now, given a little bit of a war here in Europe. And not so little. I'm sorry if I was kind of unpolite on that one. So First North, huge success in terms of new listed companies. And I will show you that this is very much driven by household investments, and households actually, they create this market. And on the aggregate, just to show you the difference here, 520 new companies listed on our junior markets during 7 years here. And if you compare to IME, and that's the UK market for small companies, and that's a country with 67 million people. The Nordic countries here is 25 million. And the Euronext countries, that's France, Belgium, Portugal, the Netherlands, Ireland, Italy, 176 million people. I looked that up today. And they have attracted 224 companies. So the Nordic markets really stand out in terms of attracting small growth companies to become public. And here you see the size of our markets, and this is a busy picture. I'm sorry for that. I'm a former financial analyst, so it tends to always become a little bit busy here. But just as a reminder, Sweden in here is like a little bit more than half the Nordic markets alone, and then Denmark and Finland are the kind of second half, roughly. And Sweden has been really developing actively. Here you see the number of new companies and raised capital during the last few years. This is just to exemplify the fact that, as you can see, 2021 was a huge boom in terms of both new listed companies and in terms of raised capital in IPOs and also secondary offerings. So a huge amount of new capital was put into our markets during the last year, but good activity before that even. Back in 2017, I said that we are never going to beat that 119 new listings, but because I thought that was the boom year. But I'm kind of glad that I was wrong. Here are the listings in Finland last year on the First North market. So 23 new companies. I will just jump this really quickly to show you that on the main market we had kind of only 8, and that gives you the proportion of companies going into the market. So it's really focused on small companies. This is the beginning of the year, of course, huge impact from the war, the aggressive war that started on 24th of February. We'll see how that evolves during the year. But now there is a little bit of a standstill in terms of new companies coming in and investors finding new investment opportunities, completely new. If we look at the markets on an aggregate level, 544 companies, average market value is only 126 million. And as you can see, when they enter the market, they raise really small amounts of money per company, on average 30 million. And but on the aggregate, it then adds up. And it's a huge variety of industries that they represent. In Finland, even smaller amounts, 20 million average IPO capital, and practically households pick up a decent share of that. These companies could probably not list unless there was household investments coming in. And they are small, so the median sales or revenue of these companies is around 15 million. And we have had some companies that list on the public market without having any revenue. They just have a plan, hopefully a great plan, or how to grow. And putting this into perspective is important, I think. And here you see early stage company capital raised over the past 10 years or 11. And it's been growing nicely in all kind of segments, as you see, be it business angels, venture capitals, domestic or foreign, which is great. And First North, that Nasdaq runs, has been around 20% of the total, but last year it completely boomed. And out of the 1.5 billion raised, there was actually IPO was like 650 million, and the rest is secondary offerings and directed issues from these small companies. So there's a huge kind of input of new capital into these companies, and companies entering a public market. So you could actually argue that there's this kind of a shift, because all these others providing capital to small early stage growth companies. They are not households, unless you kind of say a business angel is a household, but I wouldn't. They are kind of professionals in their own area. So huge impact from households investing. And here you see the distribution of trading post listings, and internet brokers are just for retail investors, the likes of Nordnet and Avanza in our Nordic countries. And Nordic banks and brokers also, more than half of their volumes are households trading through a Nordea or a Handelsbanken or someone. So the argument here is that more than half of trading in terms of volume and number of trades is coming from households. So they are hugely important in terms of price formation and liquidity. And then the question is, of course, for a researcher, is how efficient is a market like that? But I'll leave that to you guys. So my argument here is that creating this kind of a market where you have a lot of interesting companies, they have innovation, they have growth ambition, they want to conquer the world, they need something. And that's typically capital. And here in the Nordic countries, we have built a little bit of a new way of doing that we have these junior markets that are public. They are less regulated than the real stock exchange, but they are kind of regulated enough so that households and institutional investors, for that matter as well, feel comfortable that they can provide the capital for these companies and get interesting investment opportunities in a kind of a new, unique ecosystem. And it's all about job growth, right? And we know that small companies are the ones that create the new jobs in our economies, typically. And we made a study, because there's really a limited amount of academic studies on this one, that the first not listed companies that we have, this is for Sweden actually, that they have double the job growth of other similar size small companies in the same country over a period of 12 years here. So they are like double growth companies from a welfare and economy point of view, which we are really proud of. And then to the household accounts, you probably know that the Nordic countries have had this kind of a investment saving account scheme. Finland was the last one to join the club in January 2020, and we have now 280,000 accounts opened in just like 15 months or 14 months, which is quite impressive, I would argue. And Sweden has had investment saving accounts with incentivized, tax incentivized equity investments already for 10 years, since 2012. And they have 3.1 million accounts now. In Finland, you can only have one account. So we know that it's 280,000 people that have that account. So it's 1 in 20 in Finland having that kind of an account now, investing in directly in equities. In Sweden, you can have several accounts, and the 3.1 million is somewhere around 2.5 million people. And that's 1 in 5 of the Swedish population. So 20% in Sweden have this kind of an account now, after that being available for 10 years. I think Finland is on the same trend to get there, because you see, actually, we have this book entry account system that's kind of public information, that we just exceeded 1 million accounts in Finland for equity investments in total, and the investment saving account is a kind of a sub part of that. And as you can see, it's been a kind of a steady growing around 10% per year now for the last few years in terms of households coming into the market. So we are creating a financial ecosystem where retail investors are getting in. Financial literacy efforts are very active these days from many institutions, including Nasdaq as an exchange operator. And it's a good ecosystem evolving gradually. Sweden is the kind of big example of momentum with a very unique mass market in terms of what I would say, citizen capitalism. And Finland is a good number 2 now, Denmark number 3. I'll leave this to maybe the panel if you kind of wonder why this has happened. And just comment that given good markets, we would have a long list of companies, growth companies in Finland that would like to go public. Here's a little bit of an unofficial list of small and a little bit bigger companies as well that have indicated that they would like to go public to raise capital to fuel their growth. And that, of course, is a fantastic investment opportunity for households and institutions. So let's hope we get back to more normal going forward so that our markets can provide that to investors near and far, small and big. Thank you.
Thank you, Lauri. Last but definitely not least, we will have Leena Mörttinen give her remarks. And after Leena, we'll open the floor for discussion, so you can already start thinking about questions to our experts, both those online and those here on front. But Leena, please.
Thank you, and hello everybody, both here in the room as well as online. Pleasure to be here, particularly a great privilege to speak after such good presentations by the gentlemen, all 3 of them from interesting perspective, all of them. I thought that my role would be more of a macro backdrop of what we are experiencing and also sharing a bit of the pain of the legislator with you of what we've seen of late. I'm presenting a hypothesis and no proof of it. So I'm happy to debate it with you more of why we see behavior that we haven't experienced before also on the retail side now. And we don't get into the institutional investor side at all, but I think they may suffer from some ailments that also the retail investor suffers, although of course they have much more data and analysis capability behind them to avoid the sort of obvious potholes that are present in the modern world. I believe that we live in a sort of a postmodern hell that is caused by 2 things. And this is my personal opinion, by the way, not the Ministries of Finance. The first one is the fact that the social media has created bubbles around us, and we all see them, how easy it is to cover yourself with the like-minded people around you and believe that your world is the right one. And I can see that particular retail investors, regular people may actually very easily find, even the size of Finland, a country size of Finland, in a global system, a group of people that would think alike, and it would be easy to find like-minded who believe that they can actually be a force as well to change the world. And financial markets are very easy to hate as well. I think the main problem that started was the global financial crisis that really changed the attitude towards the markets. And after that, we have walked a path very much towards politics from the effective functioning of the markets. Because the global financial markets actually was a crisis of the macroeconomic theory as well, very much. I mean, we believe that the markets are always right and correct or not, that they would price the risk correctly as well. So it was an idea of the efficiency of the markets. And when that failed, the sort of a belief generally in the rightness of the markets changed. And of course, the regulation increased quite a bit. Supervisory methods became more intrusive, and the legislation made sure that the capital and liquidity buffers were in place for the banks, but also that the markets would properly function and also protect us investors. So it was a big step towards something that we are still actually working on in Europe, which is the banking union, to get that established. And of course, also the capital markets union is still under process. But of course, I mean, it didn't stop there. And the global financial crisis was a huge shock, and it was followed in Europe by the euro crisis. So we first took off the table the idea that the markets are always right. Clearly, they are not as right as they thought they would be. So they need more of regulators' interference and legislators' interference. The next crisis we had was the idea that we wouldn't have a crisis in the euro area, because we have a Stability and Growth Pact, well, that we had one nonetheless. Well, euro survived, but of course we came to conclusions the regular rules and the market discipline on governments clearly didn't work. So that was taken off the table. And let me remind you all, we are talking about things under 15 years. This all has happened. Now we were then hit by COVID, which is a pandemic. We knew it could happen, but we never believed that it would happen during our lifetime, of course, and it would be of the global scale. So our security of sort of on the environment and health was taken apart. And now finally, a terrible war in Europe also wasn't supposed to happen because the globalization was supposed to be such a strong linking factor between the different countries so that you would never dare to threaten the idea that your economic benefits will be wiped away by the fact that you start becoming aggressive towards another democratic nation. And that's off the table. While we've gone through this crisis, and of course we are in a high crisis environment, the political tools have been more and more interfering. And of course with the pandemic, as well as with the war, we only don't have very loose monetary policy, we also have very loose fiscal policy. And that sort of starts playing with your head when you think that you are limited in many ways in the way you can behave. And if you think consumers, particularly by the COVID, being forced sitting at home, nothing else to do but to figure out what to do and also save money, of course, because of course governments were trying to help households very much as well as companies. We will keep on things calm, but very boring. And people start looking for something interesting to do. So I found it extremely interesting when the cult phenomenon of meme stocks came to fore. And then you started thinking as a legislator and a regulator, whether you should interfere in people's willingness to use their money and waste it away without fundamentals supporting it. So we have this phenomenon now that we have detached ourselves from the sort of regular thinking of market economy. And now, of course, a really tricky thing is that we've done all this. We've had the pandemic and we had the war. And one thing that wasn't never supposed to happen, according to many economists, was inflation. But due to the fact that we have these crises, we've actually broken and will continue to break some of the global value chains. And at the same time, we have caused quite a supply bottleneck phenomenon across the world, and of course, demand shocks as well. So you combine that, and now you have hiking inflation, increasing interest rates, because central banks will have to do what they need to do. And again, there is a shock in thinking how the system functions, because all of a sudden, I believe there's a generation of economists who did not believe in inflation anymore. And if you go back to the sort of fiscal policy rules, you think about, if growth is always going to be much faster than, the rates, then there is no limit to how much indebtedness you can actually handle in an economy or in a consumer's life. So these are sort of quite drastic things that have happened. And my question to the professors and others are, surely the macro phenomenon does affect all of us. It affects the institutional investors. It makes it very difficult to say what is the fundamental anyway. What is the right price for anything when it's so difficult to price the future? And it's so difficult to forecast even under the war. So welcome to my hell, basically. Thank you.
Thank you, Leena. And thank you to all four presenters. It was very interesting to hear four presentations from completely different angles on the same very topical topic. So now I invite Leena and Lauri here on stage. And of course, Terry and Modo are with us there online. And we're going to be running until 7 p.m. Finnish time, which means we have about 25 minutes of quality time for questions to our esteemed experts. So here in the hall, you can raise hands, and online, please use the question box to type your questions. Who wants to start, please? And Greta will be giving the microphone out here in the room. Anybody? Here, please. And you can address your question to all the panelists or some individuals.
I'll address this mainly to the more practitioner side, I suppose. So if you run an exchange, are you happy, or are you sort of in a difficult position whenever you have these rushes of retail trading? Because I mean, clearly they don't bring much in terms of market efficiency, and they potentially bring a lot of headaches, but at the same time, they're also business, right? And so what are the sort of the pros and cons and some of the challenges that an exchange faces when they have these sorts of unexpected booms that happen?
That's a really, really good question. And that's I would say, on the balance, of course, it's business as well. It's typically not huge, but it is business when trading kind of takes off in a crazy way sometimes. But definitely, I think that the markets is all about trust and credibility, and those kind of events do not improve on credibility or build trust with the broader investor base. So I would say that on a longer term basis, it's a net negative when we have these kind of crazy events happening. And I think it kind of erodes a bit of the trust that people should have for the markets that we and other exchange operators run, because it's all about investors finding good investment opportunities, for companies to be able to access capital markets, to raise capital, right? And they both have an interest of price formation and liquidity. And the more liquidity you have, the better price formation you have. And hopefully markets are efficient enough so that prices are kind of reasonably rational, like most of the time. And then we can always discuss, bubbles, valuation bubbles, because of, demand-driven things, or valuation bubbles because of central bank rate policies and stuff like that. But that's then kind of within that scope of hopefully running efficient markets that can deliver a good service, both for the listed companies and companies wanting to come to the market, tap into it to raise capital, and then for investors.
Leno, you want to continue on that?
Yeah, I'm sort of asking Lauri as well, whether, because they are such a, it seems to me at least, ex post, everything is ex post, very easy to figure out, but it seems that like you could filter them out. You could point very quickly where something goes crazy. Would there, but of course, then you would have to talk against that particular spike that you observe in the data, but surely the...
Yeah, and for these cases also, we do have a lot of kind of guards for the market in terms of functionality, like volatility guards, that the stock cannot like shoot up immediately in a crazy way in Europe and in the Nordics, different from the US, because that's a more kind of a free moving market. But we have volatility guards where you actually, if a stock moves too much on too little volume, the market actually stops in that stock. You cannot trade it, and it will take a pause of 60 seconds or 2 minutes or 3 minutes, depending on how much it's been moving, so that the market would kind of react. Everyone would take a look at, hey, this stock was stopped by the exchange because it's moving way too quickly on small volumes or small orders. So what's happening here? And it also gives the opportunity that people that know where the stock maybe should be trading, they can come in and stabilize it, like market makers or institutions that kind of feel that, okay, if something goes from 10 to 100, I'm going to sell some, right? And those kind of adjusting mechanisms we do have.
If I may add, I mean, it's a fascinating thing what the supervisors should do in this situation. Should they interfere? Should they say that is not right? And it really is about whether, if you gamble your own money, nothing should stop you doing that. But if you're doing something wrong, and to be able to identify whether there's actual wrongdoing, you would have to get deep into the social media, those discussions and chats where the information is exchanged, is what is driving that and who is benefiting. So it actually increases the pressure on the supervisors to do much better work in this with this high frequency data as well. So I think that'll improve over time, hopefully quick.
But mistakes do happen. And an example, I don't know, most of you have probably seen that we had actually, according to our information, a first and only flash crash this week, Monday, in Europe, where suddenly on Monday, around 11 o'clock Finnish time, just before, there was a huge selling pressure in a lot of European index stocks, large cap companies. And suddenly indexes in like Finland went from trading at -2% to trading at -8%. And then 2 minutes later, it was back. The same happened in Sweden, Denmark, all over Europe, actually in France. And it was like, who kind of did something? And it's actually turned out to be a human mistake by a person with a fat finger that just triggered a huge selling order all over Europe. And the funny thing about that is that it was a UK-based bank. It's in the public domain who it is. The thing was that it was a UK banking holiday. So they were very scarce on resources probably there. And I don't know what kind of a trainee or junior did this, but I think that someone is going to lose their job because that became very costly, I think.
All right, very good. Next question here. There's the microphone coming. Oh, you have one.
Okay, so I mean, these were very interesting presentations from all four of you. So going back to Lena's discussion of hell and the four crises in a very limited period, right? I mean, we have the financial crisis, the fiscal crisis in Europe, we have COVID, and we have the war. I'm asking now everybody, also the academic side, but also you, do we have enough understanding, enough data of how households in particular have been reacting to these four crises? Can we say that households on the whole have been rational in, their reactions, or, very jumpy and, very much taken aback by developments? And what lessons do we draw, going forward, for regulators, for practitioners, for researchers? How much do we know about the response of households to the four crises in sequence?
Either one of you want to start?
I was thinking, should we give it to the professors
Sure.
online as well?
Sure. Terry or Mara, who wants to go first?
Okay. First of all, I don't really know the answer. And it's certainly heterogeneous. So you've gotten very different reactions. Like say one thing, I'm not quite sure what the rational response is to something like war as far as investing goes. As Lena pointed out, our crystal balls don't work very well at times like this. It's really difficult. I would say the same thing when COVID started. March 2020, I said to a colleague in March of 2020, well, I guess I won't be going to the European Finance Association meetings in August. And she said, what do you mean? The shutdown is for 6 weeks. And I said, well, I just can't do the math where this thing is over in August from, but so a person could have said, well, I'm pulling out of equities because we're about to enter a crisis that no one understands is going to go on for a long time. Someone else might have said, yeah, but if the Fed pours a whole lot of money into the country, where's it going to go? To the extent that investors are putting money into the market, it supports it. So it's not always clear what the rational choice is. Irrational is easier to identify, or at least, I don't know about irrational. It's not necessarily irrational to buy GameStop because you're bored. However, it's not linked to fundamentals. And as Mota said, when you have people buying stocks or crypto or anything in a way that's essentially disconnected from fundamentals, you get markets that, if enough people do it, there's nothing keeping the prices tied to fundamentals. Yeah, I think most financial economists believe that in the long, long, long run, a company's price is going to gravitate back to some reasonable multiple of earnings. In the short run, it can go all over the place. So I'd say most of the US investors have probably either just sat pat on their 401k plans, which turns out to have been a good decision. And we have a lot of people trading for various forms of entertainment, which may not be irrational on their part, but isn't doing market efficiency any favors.
Laura, you want to add to that?
Yeah, so I think there's like two, following up on Terry, I think there's two facts that are related to this, which is, one is there's a lot of capital that's tied up in index funds, retirement funds that are just not moving around much. So then they create a base for which makes the market overall very inelastic, right? So it's opposite to kind of like the intuition that there's lots of arbitrageurs out there who are going to correct mispricing. You know, a lot of capital is already like kind of very immobile, so that makes the market very inelastic. That combined with the fact that there's a lot of disagreement and small shocks can actually cause very big price effects. So like a good example of disagreement is like back in December 2020, there was news that Goldman Sachs had a price target for Tesla, $780, JP Morgan Chase, $90. So how could like two like very reputable firms with experts disagree on the fundamental price of Tesla by a factor of 10? Okay, so there's like so much disagreement. So combine that, like the disagreement with the fact that lots of capital is tied up in elastic, small shocks cause like very big price effects. And that actually makes the work for regulators and governments very hard, because it's hard to control volatility, right? If small shocks can cause very big price effects, yeah, it's very hard to control. So I think fundamentally we need to understand better like why demand is so inelastic. And getting with this audience, I think getting into the details of like exactly how households are trading and what's causing volatility, I think that's a very important research topic.
All right, thank you. Just Lena or Lauri.
Yeah, well, the good thing in the Nordic countries is that we do have two really big retail brokers with online household clients, retail clients, and Avanza and Nordnet, and they actually provide the market with statistics on a monthly basis in terms of net buying, net selling from their client base. And based on that, you can draw the conclusion, and then you can kind of think about the reasoning behind it. But the conclusion is that always when there is a big market-wide disturbance, negative volatility, prices fall, these households, they are net buyers, clearly. They are also typically net buyers mostly in company-specific events, like a big profit warning from a listed company. The households are net buyers and net sellers are institutions. So there is kind of a structural bias there. And my kind of practitioner's reasoning is that households are still probably feeling that they are underexposed to equities. And if there is a sale, they are ready to buy more. That would be kind of the easy reasoning. I don't think that they are kind of thinking so much on the particular valuation of the market just then, but they see that suddenly something is cheaper than it was yesterday. So I'm a buyer. That would be one of my conclusions. The other conclusion that I think is really important and comes back to the credibility and trust. Throughout all these shocks, starting from the financial crisis, as you remember back in 2008, it's really important to remember that equity markets in particular, they tend to work throughout these kind of crises. They are open from morning to evening. We have price formation, we have liquidity. You can do whatever you want. And that's a huge point in terms of trust. And it's very different from fixed income markets. I don't know if some here have studied that sometimes the fixed income market, which is based on bilateral trading between banks, it can completely dry up in a crisis situation. And there is nothing you can do. And that, of course, the households are not there. But for institutions, it's really, really painful that you cannot actually handle your risks in that kind of a situation of disturbance. But equity markets are very transparent, open all the time. Sometimes we don't like what's happening there in terms of share prices, but especially in a crisis, but you can find liquidity if you want to do something with your positions.
All right, Lena.
Yeah, I actually very much agree with Terence Odin on this. I think it's, I mean, my problem is what happens next and what is price of anything. So then what is rational behavior? I guess we have to go back to preferences, and I've been wondering about GameStop and the meme investing and meme stocks. I mean, if you have a mission to do something, it is not to make yourself wealthy or win on this, but you have a mission of another kind, then you can use the markets as well. And that's interesting and important to understand. There may be, of course, naive investors. I'm sure there are retail investors more likely because they have less capability of analyzing all the data. But then there are those who are not using it for that purpose, who have another purpose for it. And that's the difficult world when we start, stepping away, like globalization. When you give up on globalization and go to geopolitics, it's not about making everybody wealthy and the cake and the pie bigger for everybody. It is about really, zero-sum games. And that's a nasty world to be in. And it has its impact also on the markets. And I'm sure not all of it is irrational, but the crises are extremely difficult to figure out, and the people's behavior, particularly in this, because we also have these huge phenomena that relate to the way social media and people find their own groups that used to be so that they didn't even exist. So this sort of bubble behavior in people's thinking and minds.
Right, thank you. We take next question. Anyone? There's one. Hold on just a second.
My question's for anyone in the panel. I wanted to ask about tax incentivized accounts and whether they're good from like a social perspective. So like at least in the UK, we have ISAs. So you don't have a capital gains tax on any realized gains. And then you also have on top of that pension accounts and tax relief. But if we think just about what a subsidy does, we want to have a subsidy where there's some sort of positive externality or positive internality that people aren't taking account of. Is there some sort of externality or internality that justifies having these tax incentivized accounts?
Maybe we'll start with online experts again, so we don't forget about you. Terry, you want to start?
So I guess the question is, does it make sense to have tax incentivized accounts? Well, I think in the US, it does as a second best in that we're now forcing workers to save for their own retirement. So anything that encourages them to save is probably a good. So psychologically knowing that the money put in these accounts is subject to lower taxes probably encourages savings, possibly even to a greater extent than the actual tax savings. By the way, retail investors don't appear, at least in one study I did not appear to be that tax sensitive. I showed you the finding in the Taiwan paper that we did on when a lottery was introduced. The main finding of that paper was that over the period 1995 through 1999, for which we had the trading records for every single investor in Taiwan, retail and institutional, the retail investors lost the equivalent of 2%, 2.2% of GDP each year through their trading activities. They were paying fairly high commissions. They were making money losing trades with the institutional investors. And there was a transactions tax. And one might have thought, oh, well, if you have a transaction tax, nobody's going to trade. Didn't seem to slow them down very much. So, I feel that in the US, there's quite a potential for a retirement crisis out in the future. And that if we're not going to have defined benefit plans, which I wish we did have, offering incentives to get people to save for retirement are important, is important.
Great, thank you. Moto, what's your thinking on tax incentives?
Yes, I echo Terry's what Terry just said, that these accounts are very important to supplement Social Security, which in the US is apparently probably going to be inadequate for most households. Yet the key fact is, if you look at the bottom 20th percentile incomes and the bottom 20% of income in the US, the participation rate in retirement accounts is only like 20%. So 80% of households don't participate in these accounts, despite the large tax incentives to do so. So that's kind of a research shows that tax incentives are not enough to encourage households to save and even open up these accounts. Now, what does seem to work is now 10 states in the US, including my home state, New Jersey, and Terry's state, California, we actually require all employers to offer an employer plan, or if they don't offer an employer plan, automatically default them into a state-sponsored savings program. So kind of like the research, like Dick Thaler's research on nudge suggests that it's not really tax incentives that's going to save us. It's nudging people into, defaulting them into these accounts, and that apparently increases participation quite a bit more. So even though tax incentives maybe are intended to do the right thing, then maybe they're not as effective as we thought. And we need a kind of a more of a nudge approach to default these guys into saving.
Your Minister of Finance opinion.
It's been a really difficult struggle to try to figure out why Europe is so bank reliant. I mean, the whole money creation system is quite different from US as well. And of course, we saw in the global financial crisis that the US system and European system both have their problems, but our problems usually have been related to extremely huge banks compared to the size of the governments and the size of countries, and then the difficulties in financial crisis to make sure that the system is stable. So there is sort of a long-term wish to really induce deeper and wider capital markets. So we have the Capital Markets Union, which is still very much on the agenda. And it's interesting, by the way, that through this crisis, as everything becomes more political, also the nature of the big headline key things that we try to achieve, which is the banking union and the capital markets union, their nature changes a bit, which is important to follow when you see discussions in the media as well of what they turn out to be. But the capital markets union has been an attempt to try to reduce the role of the banks and get wider and bigger participation from the retail side. And there are various tools that we consider what could induce that, but it's really, really difficult to get people give up their love of deposit accounts and investing in their own houses. So that's sort of a continuous pattern in Europe that the legislators struggle with. And of course, what is a right inducement that doesn't sort of distort people's real preferences, but really gives them idea of they could do things differently. So I think that's, the equity savings accounts and the tax benefits given to those is one attempt to achieve that, to get people interested in investing. But of course, if the trading is so cheap and it is so very, very easy, and now of course that there is, excess savings having to, happen due to the COVID, that the inducement may not be necessary because people may invest otherwise as well. But it's also a cultural change that we are looking for. And I think the cultural change is a big part of it. And that's where tax incentives play a role as well.
Yeah, and I could add that way back in 2012, when Sweden introduced it as the first country in Europe to have a direct equity incentivized scheme for accounts, it was really to get away from a disadvantage that equity investments had relative to mutual funds. And back at the time, mutual funds were mostly very expensive, taking 1.5 to 2% in terms of fees, and they were practically all more or less index funds. So you would be buying the general index of the market anyway. And that was a little bit of kind of a competition. And of course, back then, and still I would argue that declaring all your gains and losses and calculating what you need to pay afterwards in terms of tax it's not all that simple. And these tax incentivized investment saving accounts, you get rid of all that completely. You don't need to declare anything in terms of what you do in that account. It's all automatic, and the banks will actually inform them if there is a taxable withdrawal later. So that it's also, besides the tax incentive, it's also made really, really easy to get going and to trade back and forth if you want to.
All right, thank you very much. Time went fast. We are at 7 p.m. So we need to continue. At least here, we need to continue our discussion over dinner. But I want to thank all the participants online and here in the crowd, and in particular, thanks to all the experts for very interesting talks and discussion. Thank you very much.